There's a specific moment that happens for many professionals at late-stage private companies. You open an email. It's a tender offer. For the first time, your equity, something that's lived purely in spreadsheets and theoretical valuations, suddenly has a price tag attached. In that moment, the wealth feels tangible, liquid, life-changing. It feels like the company is handing you a massive personal reward for your hard work. But companies don't run tender offers out of generosity. They run them because early investors want partial exits, new investors want access before an IPO, and the board wants to control secondary market activity. You are being invited to participate in a capital markets transaction that serves multiple institutional parties. And because it is framed as an opportunity, it frequently becomes a decision trap, a moment where highly intelligent people make deeply flawed financial choices. Most employees approach this decision completely wrong, falling into distinct behavioral traps. First is the true believer. They go all in. They refuse to sell a single share because they are entirely convinced their company is the next generational unicorn. To be fair, sometimes that thesis is entirely correct. If you held every share of SpaceX from the early days, that strategy paid off immensely. At the opposite extreme is the panic seller. They see the sudden rush of liquidity and react impulsively, trying to offload as much equity as the company allows, usually without a tax strategy or a plan for the cash. And sitting right between them is the confused optimizer. They hold, they sell, they cancel the sale. They are completely paralyzed by the fear of making the wrong choice and regretting it for the rest of their career. The math of a tender offer is complex, but psychology drives the outcome. This decision requires looking past the simple permission to sell and focusing on the long-term role of the asset. Extreme reactions, holding everything or dumping it all, usually signal that emotion has replaced strategy. To remove emotion from the equation, you have to start with the hard numbers. That means executing a concentration audit. This horizontal scale maps the percentage of your total net worth tied up in your company. If your equity represents under 20% of your total assets, your exposure is manageable. You have room to maneuver. If you are in the 20 to 50% range, your exposure is meaningful. You need to actively manage this position because a fluctuation in share price will have a very real impact on your personal balance sheet. But if you cross the 50% threshold, everything changes. Your financial life is now dictated by this single asset. When your net worth is this heavily concentrated, you expose yourself to the risk of ruin. Your financial survival relies entirely on one specific leadership team executing perfectly. If the company falters or the IPO market cools, your wealth evaporates. Crossing that 50% line turns your financial life into a high-stakes wager, a position that invites catastrophic loss if the company fails to exit. Even when employees recognize this risk, they often fall back on a convenient assumption. If I don't sell now, I'll just wait and sell in the next window. The private markets do not work that way. IPO timelines stretch indefinitely due to macroeconomic conditions, and secondary market windows can slam shut without warning. While a few massive, mature private companies run recurring liquidity programs, the vast majority do not.
The window you are looking at right now might be your only access to cash for the next 3 to 5 years. Refusing to sell under the illusion that you can exit later preserves your theoretical upside, but it guarantees that your actual wealth remains entirely trapped. Then comes the fastest way to lose money in a tender offer, the headline trap. People anchor their financial decisions to the gross offer price, ignoring the massive gap between that number and their actual take-home pay. This waterfall chart breaks down what you actually keep. If you are exercising and selling non-qualified stock options, the spread between your strike price and the offer price is taxed as ordinary income. A massive chunk of your payout disappears immediately to withholding. Incentive stock options follow a completely different path. While there's no regular tax on exercise, you face severe alternative minimum tax exposure. And if you sell immediately in the tender offer, you trigger a disqualifying disposition, wiping out the tax advantages you thought you had. RSUs are generally simpler. You already paid ordinary income tax when they vested, so selling them in a tender offer usually only triggers minimal capital gains or losses. But there is a massive wildcard, the 409A premium. If the tender offer is priced above internal valuation, the cash source dictates your tax bill. If the company is funding the buyback, that premium is usually taxed as brutal ordinary income. If outside investors are buying the shares, it might qualify for capital gains. Skipping the tax math means you will realize vastly less cash than your spreadsheet projected. It turns what should be a calculated liquidity event into a surprise tax burden. When you account for the taxes, the timeline, and your actual net worth, the optimal answer to a tender offer is rarely to hold everything or sell everything. The smartest move is a structured partial exit. Liquidating just 10 or 15% of your holdings can tangibly improve your life today. Wipe out high-interest debt, fund a home purchase, or build a cash buffer that eliminates your daily financial anxiety. And the math still works in your favor. If the company goes on to double or triple in value, the vast majority of your shares are still active. You haven't missed the moonshot. Partial liquidity allows you to rewrite your risk profile. You can secure your immediate financial health while keeping most of your shares active for the next phase of the company's growth. Looking at this 4-quadrant matrix, we can map exactly what you should do based on your personal concentration risk and your actual need for cash. If you are in the bottom left, meaning less than 20% of your net worth is tied up in the company and you don't urgently need cash, you can afford to be a true believer. Hold your shares and defer for maximum future upside. But if you are on the right side of the board, with more than 50% concentration, you need to aggressively liquidate. Regardless of how much you believe in the company, you need an off-ramp to escape the risk of ruin. For most employees sitting in the middle, the top left quadrant is the goal. Execute a structured partial exit to pull out enough cash to hit your life goals while letting the rest ride. A tender offer forces you to decide how much of your future remains in one place. Use this window to align your paper wealth with your actual life, rather than trying to time a volatile market. It's about acting with intentionality so that your wealth actually serves you.